What if the biggest risk in your business right now isn't taking too much risk, but taking the wrong kind at the wrong time? Welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today we're diving into part 3 of our Design to Last series. I'm excited to be back here with Michael O'Keefe. In the first 2 episodes, we talked about financial health and strategic health, getting your numbers right and your structure aligned. But even when both of those are in place, there's still a question that determines your long-term outcome. Are you taking the right risks at the right time? In this episode, we're unpacking something every entrepreneur feels, but few can clearly define: how risk should evolve as your business grows. Because what we see time and time again is entrepreneurs either going all the way when they should be protecting or playing it safe when they should be leaning in. And that misalignment doesn't always lead to failure overnight. More often, it creates an invisible ceiling or costs you years of momentum. So today we're going to walk through the 4 stages: build, protect, multiply, and legacy, and give you a clear framework for how to think about risk in each one of those phases. If you've ever felt that tension between growth and security, or wondered if you're making the right moves with your business and your wealth, this episode is going to bring a lot of clarity. And before we jump in, if you want to go deeper on the tools, frameworks, and strategies we use with our clients every day, head over to vitalwealth.com/resources. That's where we've built out a full vault of tax strategy and wealth building resources to help you actually apply what we talk about here. Again, that's vitalwealth.com/resources. And if you get value from today's episode, make sure to leave us a review. It helps us reach more entrepreneurs who are trying to build something that actually lasts. All right, let's get into it.
All right. Welcome back to Design to Last. In episode 1, we laid the foundation on what it actually takes to build a business that works, not just one that generates revenue, but one that's actually structured to last. We broke that down into 3 core pillars: profitability, clean financial reporting, and a clean cash management strategy. Then in episode 2, we shifted the lens and we talked about the 4 stages of competence and what it means to evolve from being the operator inside your business and becoming the architect of it. And so in today's conversation, where we're going to dive into the different stages of risk that an entrepreneur will encounter over the lifelong journey. I'm really excited to get into it. Pat, happy to be back.
Yeah. Thank you, Michael. This is going to be a fun conversation because we get into a lot of these things with our entrepreneurs, and they're typically facing a whole host of problems. When we think about externally, they're trying to figure out how to grow the business and maintain stability. They're thinking about investing in the business versus outside of it, liquidity versus how do I build this asset? And there's always new opportunities, and how do I stay focused? But they're really lacking a clear framework for how risk should change over time. Oftentimes they're taking too much risk at the wrong time, or avoiding risk when they should lean in, or get distracted by new opportunities, or they're just failing to protect this thing that they've built. It's built on something other than a solid foundation. And then there's these internal problems, right? They're feeling like, man, what is the right next move? How do I manage this tension between growth and safety? And then there's also the concern about how do I preserve this thing that I've built? I've got a lot of people that depend on it now, not just my family, but my employees and their families, and just the excitement also about opportunities, but unsure what to pursue. There's so many opportunities, especially when you start accumulating some real wealth that start to get your attention. And then there's just fear of making decisions that they'll regret later. So, and there's this constant internal question of, am I making the right decisions with what I've built? And then philosophically, it should not be unclear, but it is for entrepreneurs who have taken the risk. They've built something valuable. They've created momentum. But they're left guessing on how to protect it, grow it, multiply it, sustain it. And so risk shouldn't feel random. And so we're going to get into that discussion today. It should be aligned and intentional. And what we find with capable entrepreneurs is sometimes they stall because they get conservative too early, or they lose wealth because they stay aggressive too long. So we're going to talk about how to unpack all those things today. So I'm really excited about this conversation.
Yeah, awesome. I'm super excited. Let's get right into it. And to just kind of set the stage, I think it would help to go through and just outline the 4 stages that we'll walk through today. And that's step 1 is the build phase. Step 2, protect. Step 3, multiply. And step 4, legacy. So why don't we get right into stage 1, build. So everyone starts here, and it can be an exciting part of the journey, but it can also be scary sometimes. So Pat, can you walk us through the build stage of risk?
Yeah. So this is interesting, and I think we should maybe start like at step 0, and think about who should enter into this entrepreneurial journey. Because as advisors, I think in good conscience, if I'm making a decision for like helping somebody make a decision, it's don't become an entrepreneur. Statistically speaking, this is not a path you should come down. You're probably better off from a financial point of view to go get a W-2 job and just start spending less than you earn, put some money aside, and your eventually your financial security will be taken care of. Now, this conversation and this episode and this entire podcast is not for the W-2. It is for the people that have decided to lean into being an entrepreneur. So when we think about this build stage, the interesting part about it is you've got to just be willing to push all the chips in, and this is the time where we're taking risk. We're trying new things constantly. We're seeing what works, what doesn't work, and there's a lot of hustle involved in this part of the business because we're trying to get this thing off the ground. And I like the analogy of the airplane. The airplane uses so much of its energy to get to cruising altitude, and that's where we're at. We're in this like phase of we're trying to get to cruising altitude, and so we are spending a lot of energy to get the business off the ground.
Yeah, this is really good, and I love that airplane example. So Pat, what I think I hear you saying is that if you're gonna get into this game, it can be a brutal game, and but you can also experience a lot of fruits of your labor, and you need to go all in and be willing to fail. So I'm wondering, for a new entrepreneur starting a business, and they can't quite seem to get it off the ground or get it profitable, but they keep putting cash into the business, keep burning that cash. Is there a point where they should strongly consider shutting it down?
Yeah, that's a great question. So again, it goes back to the first comment we made about most people shouldn't do this because a number of business fails, and I think there is some wisdom on how long am I going to be involved in this thing before I decide to reboot and do something different. So for a lot of people, that answer can be a number of different things. A lot of times it's just cash, right? Like how much cash do I have to burn through? My suggestion is you try to do it with the least amount of cash possible, but you still need to be able to sustain yourself and eat, support your life. And so when we think about that, we really do look at how do we fail forward, and how do we just keep iterating to keep the business moving and find new ways. The goal is to start generating revenue as fast as you possibly can. Too often we see people that get excited about a business they're trying to build this thing, and the reality is they need to go sell a thing. Sell a thing and then build it. And I've been guilty of that. I decided to test out this was over 20 years ago, a real estate coaching program. And I was like, I'm going to go to this real estate group that has over 200 attendees every week. And I just put out some flyers, and I had about a dozen people reach out to me and raise their hand and say, hey, I'm willing to pay you $5,000 to be a part of this mentorship program. And I was like, oh, this is cool. I better develop this thing. So I tested the market. I figured out how to sell the offering, and it worked, and we were like off and running. So I think that's one thing. You've got to figure out how to generate revenue first. Like that is key. I think Tim Ferriss in the 4-Hour Workweek, he does a really interesting case study on how to test the market and see if there's an opportunity for you before you go all in. So that's definitely worth the read. But I think there's this point at which you need to iterate quickly, figure out how to sell and generate revenue, but also be mindful of like, this isn't working, and we need to go a different direction. And I think one thing that sort of leans into that is, and I've said this before on the podcast, but I had a mentor of mine tell me, your business will grow at the rate in which you make decisions. And so, speed over optimization, I think, is a key piece. And you just need to, you make a decision, you move forward. And if it's not working, you make another decision and you go. And so I think those things are really important. And, this is when I think about being in the build phase, the best time to do that, um, if I had to look at, a situation and go, yes, you're positioned well for this. You don't have a ton of obligations, and I'm not saying this is just for young people, but it's like, if I've kept my lifestyle to a point where I've got the ability to, I don't need to earn $30,000 a month to in my business right away to support my lifestyle. If I'm, for lack of a better term, we've got some clients that are still in college that are making a couple $1 million a year. They're living in their dorm room, grinding it out, and making some things happen. And so you could be, for lack of a better term, living in your parents' basement and making this thing go, or you've got some roommates in an apartment. So I think if you can keep your obligations low, that now that gets harder. I think about myself. I've got a wife and 3 daughters. We're used to a certain lifestyle, so it's like that's for me to be like, if pretend I don't have any financial like assets to lean on. If I just decided I'm going to quit my job and go start a business, that could get really uncomfortable for my family really quickly. If I'm like, hey, we're going to go move into a 2-bedroom apartment out of our current house we live in, to keep that business running. So I think there is something to having not a ton of obligations. It just gives you a ton of flexibility when you're getting your business off the ground. And so, but again, I think this all goes back to, if you're not willing to take meaningful risks, you shouldn't be in the game. So, yeah. Anything else that we should be talking about on the build side? I think that is pretty good so far. But yeah, any questions that come to mind?
Yeah, no, that's really good stuff. I think just the concept of or the idea of playing it small early, and going at 50, even like 75%. You need to be 110% all in on this. But that mindset cannot stay the same forever, right? And that takes us into stage 2, which is protect. So I think there comes a point where you've built a business and it's profitable, and you may not want to keep running the same framework you've been running it as you were in the build stage. So I'm curious, at what point should someone start to think about making this change?
Yeah. Yeah, no, this is really good, because the build stage is the most fragile stage in the entire process, right? This thing can fall apart at any time, because we really don't have a whole lot of margin. We don't have a lot of financial margin. And the number one reason businesses go out of business is they run out of cash. And so when we think about when we're building something, we want to start creating this financial stability around the business. And one temptation that's out there that can keep us from protecting our business is if our lifestyle starts to increase as our financial margin in the business increases. So if I start making $1 of profit and that turns into $1 of lifestyle spend, that can be really dangerous for the business. What I need to do is, going back to, living in my parents' basement, I need to just hang out there for a minute longer, right? I need to start letting the business continue to grow and create some cash in the bank that is going to be able to support and protect the business when some turbulence comes along, because it is coming. That's the nature of business. It's the nature of our economy. It's why business is so hard, is there's so many factors at play that it becomes a challenge. So I think the key thing that starts to happen when we start to migrate from, the build phase to the protect phase, is we start to have excess financial resources, and we need to start using those resources to support the business. And now I think a really important distinction is you don't become conservative here. You keep your foot on the gas. You keep this mindset of the speed at which I make decisions, my business will grow. And so effectively failing forward, failing fast, like let's keep making these micro failures and just keep moving along. And but I'm doing that in the context of I've got this financial safety net around me in the form of cash on hand, which I think is um, it's really important in this whole thing. So I can now just support the business that is out there, and it does a few things for me. So
Yeah, I think
any
that's
questions on
really,
any of that so far? Yeah.
I think that's really good stuff. And you mentioned the financial stability and that safety net. So I'm wondering, like, when someone keeps operating that build stage for too long, what typically breaks when they fail to enter the protect
Yeah.
stage?
Yeah. I think the thing that we've seen, and I'll say we don't have many clients that are not in the protect stage, because you just if you're spending everything that you're making, it's really hard for us to help you. And so, um, the thing we've seen is, and I've got some people close to me that have run businesses for maybe even decades, and they're living at this just like um, they're they're growing, their revenues are growing, but their profit isn't growing. Their every dollar just keeps sort of going back into an expanded business operation and lifestyle creep. And it's just a very, very dangerous place to be, because there's um, you know we're still not far enough removed from COVID to forget about it yet. But it's one of those black swan type things. Nobody saw this event coming, and there's going to be new and different events that nobody sees coming that are going to disrupt the way that we see and do business. And it's like if you don't have any margin, you're sitting in a very like perilous place, where it can all fall apart pretty quickly.
So moving into like the financial piece of this specifically, if an entrepreneur says, "Hey, I'm profitable," what do you want to see in the numbers before you believe they're actually in a position to protect?
Yeah. I think uh, I think we should be working on creating um, what I'm going to call cash on hand as soon as we possibly can. And when I think about that, let's just talk about some very general rules of thumb. This is gets very specific for each client, every business. But uh, I think about it personally, right? And I'm going to go back to some Dave Ramsey. Dave and I disagree on some things, but not this thing. Dave's a big champion of having that emergency fund and growing that number. And I think a healthy number for an entrepreneur is 6 months of lifestyle on hand. So if I'm spending 10 grand a month on my lifestyle, 5 grand a month on my lifestyle, let's use 5 grand a month to just support my lifestyle. 6 months of that, I've got 30 grand in the bank, just sitting there, earning some money market returns. But when it comes to inflation, it's break even. And that's okay, because it's going to support me. Now, when I layer in the fact that I've got a business involved, now we're going to dial that up. I think I probably need 12 months worth of expenses. If I have payroll, I'm going to start looking at number of payroll cycles. Bill Gates famously had, I think, 12 months of payroll on hand at Microsoft, which is an enormous number for most businesses. Most people wouldn't have that much liquidity. But Bill was like, look, I want to be able to keep my foot on the gas, and having that number in the bank allows me to just do that. And he carried that from a very early stage. Microsoft, I think, is still sitting on billions of dollars of cash. So it's um, it's worked out for them. So I think that's the key piece is like, how do you start creating that financial margin to just sit there? Now, there is a point where, using the Microsoft example, I feel like it's inefficient having too much cash on hand. And for each client, that number is going to be different, and we're okay. We're gonna give them some guidance on that, but we're gonna let that be the client's number. And so there's a bottom number. Below that threshold is danger zone. If we get below that, we should fix that as quickly as possible. But on the upper end, too many dollars is inefficient. I should get those dollars put to work. But I think having that margin, defined between upper and lower limits is really important. And I think one thing it does two things for you. A, it helps you survive in tough times. And then on the opposite side, it creates this, I don't know if resilience is the right term. Resilience helps you survive. It allows you to thrive when everybody else is struggling. Assets are now really cheap. I can go buy competitors. I can go buy assets that, are at a discount because the rest of the economy is falling apart. And so it just puts you in a position to take advantage of, I think it's a Rothschild quote about, blood in the streets. That's when I want to invest, is when there's, just chaos and it looks like everything's the worst. It's like, now I want to go make those strategic moves. And when I've got the financial margin to do it, it makes all the difference in the world.
Yeah, and we harp on it so much, but it really is, it's so important. The number one reason businesses fail is they run out of money. Like, having that cash on hand is so important. It's crucial. And I like what you said about the downturns. When you survive these downturns, you position yourself to win when others can. And that leads us nicely into the multiply phase here. So I'm thinking we've got our margin of safety that we talked about, and we've also got our excess cash on hand that we talked about. And I feel like there's a few different ways we can take this, but why don't we start with where you should be focusing your time, because
Yeah.
it can get easy to be distracted on all
Yeah.
these other different flashy things. You talked about the lifestyle creep. Yeah.
Yeah. Yeah. No, this is good. I think when we think about the multiply stage, the goal here is to, as an entrepreneur, and I think this ties back nicely to the last episode we did, when we go from that hustle to architecting the business. I think it really does come down to a focus. And when you start having, and we see this with clients, when I start having financial margin, when things start working, I start making money. I can get distracted. I can go, you know what? I've heard about real estate. Real estate sounds amazing. I'm going to go buy myself a 10-unit apartment building. And even if I have a property manager for that 10-unit apartment building, and by the way, 10-unit apartment building is probably not big enough to have like good management. So that's a whole different discussion. But what's going to happen is that 10-unit apartment building is going to start taking my time and energy. I'm going to have to invest in making decisions in, the financial infrastructure around that property. Like it is going to distract me from the main operating business. And what I've found, both in my personal life and in our clients' lives, is they end up with two underperforming assets. The business isn't operating as well as it could, and the real estate's not operating as well as it could. And it doesn't necessarily have to be real estate. We've seen clients that have been running a successful business, and they're like, oh, hey, you know what I'm going to do? I'm going to create a mastermind group over here. And they start doing that. And again, it's not that it's not profitable, like not that they can't make some money doing it, but it is distracting them from the main thing. And we've seen some clients do some pretty incredible things. Get rid of their mastermind group, sell off their real estate, stay focused on the main thing. And then all of a sudden the value of that business just skyrockets. And that's where the multiplication happens. And I want to make a critical distinction here. I'm not telling you not to invest outside of your business. I think that can be a really wise thing to do. But I think you should invest in things that are truly passive. And what do I mean by that? I would say the easiest passive thing, like if I'm just looking for building wealth outside of my business, a stock and bond portfolio, like just put some money aside. And, the cool thing about the equity markets is they've got a great track record. And if we think about, all of our friends that run businesses and the ones that have really made it, well, those are all those businesses that are, in we'll call it the Russell 3000 or S&P 500 or whatever. Like those are the friends that have made it. They've run successful businesses and scaled to a point where they're, publicly traded and, doing really well. So we think those are great passive investment opportunities, like park some dollars there. Same thing can be true of, some limited partnerships, things that like you're working with an operator that knows what they're doing, whether that's on real estate or oil and gas or something along those lines. And like the cash flow is just going to come in. It's not going to take any of your time and energy to make that thing happen. It was just you investing your dollars and being along for the ride. All of the work you had to do was the diligence on the front end to see if the person you're investing with is worthwhile. So I think those are key distinctions. I think the multiplication happens when focus is dialed in and we're not distracted by shiny things. And when we start to generate wealth, we start to get real dollars. It's really easy to get distracted by some of those new opportunities.
Yeah, I think of Newton's first law here: an object in motion tends to stay in motion. And when we're totally tunnel vision focused on our business, that gives us the best opportunity for it to compound, and that we know what compound interest can do. And when we start shifting our focus away to other things that I don't want to say don't matter or aren't important or aren't necessarily things that you don't want to do, but having that complete tunnel vision on your business is absolutely crucial in this stage. So I'm wondering, additionally, what are some other ways that we can filter out those shiny opportunities that you're mentioning that aren't actually aligned with the business that we're building?
Yeah. This might sound silly, but one of the things that we work with our clients on is creating an investment policy statement. Like, what things are we going to invest in? With a sober mind, when we are thinking rationally and not excited about a new opportunity, but we're like, okay, where do I want to allocate my capital? And that can be back into my business. And I'm totally okay with somebody going, I'm all in on investing my capital back in my business and keeping that thing moving forward. There's some risk with that, but I think we can talk about those risks. And then that investment policy statement can also say, I'm not willing to invest in this type of opportunity if it's going to distract me from, time and energy away from my business. And it really just allows us to stay focused on our goals. And Michael, you and I were talking about this before we started recording. I don't care if a client's goals are to build their enterprise value as high as they can possibly get it, and they don't care about their wealth outside of the business. Other clients are going to be very focused on like de-risking a little bit and saying, hey, I'm effectively invested in this micro cap stock that is my small business that has grown well and I know it really well. But I'm gonna allocate outside of that business into other investments. And I think once somebody makes that decision, we should be very mindful of, okay, cool, what are those other investments and how are they not going to distract from you operating the main business well? So I think that tool can help us help entrepreneurs make wise decisions when it comes to how do I multiply the value and my net worth ultimately by staying focused on the things that are going to drive that forward.
Yeah, I totally agree. Just because you can do something, it doesn't necessarily mean you should. You should take the time to think about it and make sure that it's the right decision for you.
One of the things we're always thinking about is how we can make this podcast as valuable and relevant to you as possible. Because the truth is, the best conversations don't just come from us. They come from the questions you're asking every day as you're building your business, managing risk, and trying to make the right financial decisions. So if something from today's episode sparked a question, or if there's a topic you want us to go deeper on, we want to hear from you. Head over to vitalstrategies.com/questions and submit whatever's on your mind. Whether it's about tax strategy, growing your business, protecting what you've built, or navigating those next big decisions, we're paying attention. We use your questions to shape future episodes and bring on the right experts to dive deeper into the topics that are actually impacting entrepreneurs like you. Again, that's vitalstrategies.com/questions. Send us your questions and be a part of shaping the conversation.
I think this then brings us into stage 4, legacy. And this stage is a fun one. It's exciting. So you move to the legacy stage once your financial freedom is secured, and there's not much that can derail you anymore because your financial security is taken care of. So, Pat, can you walk us through what the legacy stage looks like?
Yeah. I think this is fun, and I think you hit on a key point. We get to the legacy stage when we've built enough wealth that our assets can support our lifestyle, and we like to structure that where, with a high degree of probability, nothing's going to derail that. Okay, so I've either built wealth outside of my business that allows me to walk out of the business and say, "Hey, this was fun." Throw the keys on the roof, never come back again. Don't have to monetize my business, and my financial security is taken care of. I don't have to worry about going back to work ever again. So that can happen by building wealth outside of the business. It can also happen by, I'll say, exiting the business. If we've been hyper focused on driving our enterprise value up as high as we can get it, with the thought of exiting the business someday, I think that's great. And we get to the point where we're like, okay, cool, I'm going to exit the business. Now, generally, we see that doesn't typically all come with all cash up front. There's usually cash up front, maybe some earn out, possibly some rolled equity into the next opportunity if it's a private equity company that's buying us. And so with those things in mind, it's like I now have the financial resources to support my lifestyle. And this puts us in a really interesting position. And we start to see, when I'm here, now I get to decide what that legacy piece looks like, right? It might be charitable. It might be multi-generational, wealth. Like how do I build this wealth into a something that impacts generations to come? And so, but one of the things we start seeing here is we see people throw what I'll call ROI out the window. Okay. And what do I mean by that? I think it goes one of two ways. One, we have the ability now to make some bets that have really high upside. Okay. And let's use some examples here to sort of frame this conversation. So the traditional retirement scenario, okay, somebody works a job, they save some money. When they retire, they're probably in a 60% stock, 40% bond allocation. And that's a very generic structure. And that's been back tested to show that if you take a 4 or 5% withdrawal rate, you're effectively not going to run out of money on that allocation. You can, live for a really long time, and your portfolio balance should sustain your life. So that's cool. When we think about that, though, that might be a tiny percentage. If our clients are living on $30,000 a month, $360,000 a year at a 4% withdrawal rate, that's $9 million portfolio. Okay. Now we've got clients that are exiting their businesses for close to $100 million. So when we start thinking about those numbers, it's like, okay, I can take 9% of my portfolio and have it allocated 60-40, and it's going to take care of my life. And then I've got the other 91% of the portfolio that I can allocate any way I want. And if I'm thinking of that from a multi-generational perspective, I might be very aggressive with those investments because I'm okay with the volatility over time. And I know that volatility is going to eventually play out in higher returns. If we're thinking stock market in general, I need to be careful. Like I don't want to put all my stock in, I think about companies like GE, in the early 2000s, GE was like a darling. And, since then it's like, didn't want to have all your eggs in that basket. But with that in mind, it's like, I'm now in a position where I can take like bets and they're not going to impact my financial security, because I'm sort of carving out those dollars to make sure that I'm in good shape. And but I think this also goes back to, Michael, our discussion about investment policy statement. Like, how do I want to allocate those dollars? Some of it might be for growth, some of it might be for charity, some of it might be to support family endeavors. So I think those things all start to come into play and start dictating how we're going to invest our dollars. Any questions on that? Because there's another side of this that I also want to talk about where we don't care so much about ROI. That
No, this is really good stuff, and I don't know if I have a good answer to this. So I'm wondering, and I'm thinking back to the build stage where we're taking risks out of necessity, where that's not the case now that we're in the legacy phase. And I'm thinking that some people out there, maybe even most people out there, think that the more your wealth grows or the higher net worth you have, the more, I guess, complex your situation should be just because you have that higher net worth. And I'm kind of wondering, like, if everything is structured properly, at this stage, should a person's financial life actually be getting simpler or more complex?
Yeah, that's a really good question, and it's a challenge we face with our clients pretty regularly. I think it depends on how much you want to optimize. And you might be like, optimize? What do you mean? Well, from our point of view, we like to bring the tax bill as low as we can get it. And so when we start thinking about if somebody's got $100 million net worth, they're going to be well beyond the estate tax limits. Okay. So if I'm well beyond the estate tax limits, it's like, well, now I start bringing in, we'll call it some complex trust structures. I could be looking at other opportunities to drive the tax bill down. And then all of a sudden, what's happened is my complexity, it didn't get smaller, it got bigger. And, it started to expand. And the time and energy it takes for me to administer that complexity is also something. And even if I've got, we're a fractional family office for people that are worth, $100 million plus, right? We're doing a ton of work to make it very simple, but there's still decision making that has to come from the client on these things. And some people have a really high, what we'll call planning tolerance. Like they are totally fine being optimized and actually enjoy the process of, having all of these structures in place to accomplish their goals, whether that's minimizing tax or passing assets on to the next generation or charitable endeavors. All of those things brings a level of complexity. And so we're also okay with the client that's like, no, there's a level where I'm okay. I'm okay not being completely optimized, because it means I might not be optimized financially, but I'm optimized from a lifestyle point of view. And I'm okay with having some simplicity in my life that just allows me to, maybe enjoy more of my life versus be tied up in all of the financial details taking place.
Sure.
Great
Yeah.
question.
Yeah. I'd love to now, going back to where we were, I'd love to hear the other side of the legacy stage and maybe where things could potentially go south.
Yeah. And I don't know. So I think there is some opportunity to, and we've seen this, when, and it relates a little bit back to the last phase where we're, talking about, the, protect and just making sure that, we're protecting and multiplying. When we get in the multiplying phase, it's focus. And one of the things we've seen, unfortunately, a couple times is we've seen people that get into the legacy phase and take some outsized bets. There's family wealth here, and they've been in their lane and they've made a lot of money in a particular arena, and then they go, hey, over there, that looks pretty cool, and they have a little bit of a false confidence around, because I did it here, I can do it over there. And not that I find that business skills transfer, from arena to arena. But sometimes, if I enter a full new, like I'll just use myself as example. We've built a very healthy real estate portfolio. If I got into the manufacturing business, I don't know anything about manufacturing, like nothing whatsoever. That's a very dangerous place for me to allocate a ton of capital, take on a bunch of debt, and sort of maybe collateralize other assets because I don't know what I'm doing. I think back to when I first started in real estate, made a bunch of mistakes, which was really healthy for me to figure out what not to do in the future and to allow us to grow and scale our business. And so, if I push a lot of chips in the table into a new arena that I'm not familiar with, that's outside of my core competency, it can put the whole thing at risk. And we've seen that. We've seen this sort of very secure financial picture get very insecure because of new ventures, a lot of debt that sort of create a little bit of instability there. So yeah, I think that's something to be mindful of in this legacy piece. We don't want to see pride get in the way of the wealth that we've built.
Yeah. So what I'm hearing you saying is, at this stage, wealth is less about maximizing returns, more about building something that endures. So we see some of these people who might be in the protect or multiply stages and want to take a bunch of moonshots or increase lifestyle spending. And ultimately, the overarching theme we've been talking about today is they just need to ultimately resist the urge and have that tunnel vision. And it's all about focus on their business, focus on what's working, let compounding go to work for you, and not get distracted. Do you have anything to add to that?
Yeah, no, I think that's good. And I again, it goes back to, there's a few points you made that are really good there. I think it goes back to that, we'll call it investment policy statement. I'm okay with, um, making an investment in something that maybe outside of my core competency. I
Sure.
should be mindful of how much money I'm putting into that thing, and so if I think it has a ton of upside, and I'm like, all right, let's go allocate some dollars to that. Great. But I need to be mindful of, going back to when I had a sober mind, when I wasn't super excited about this opportunity, what did I say was a wise percentage of my assets I should commit to things like that. And then I think you have somebody in your life that is willing to have those conversations with you about, when we start wanting to venture outside of that, how we maybe make some adjustments. So yeah, I think that's key. And then another thing you said that I think we should highlight is, and I think this is true in just about any area of life, slow, consistent gains over a long period of time adds up to a tremendous outcome. And it's easy to apply this to wealth, right? Like if I just keep showing up and getting, I don't know, in my business, 10% compounded returns year after year, 10%, sounds like a pretty big number, but what we see our clients doing, like that's I would say very average. But if I can do it consistently for 20 or 30 years, the net worth of that business is going to be something that almost everybody else looks at and goes, man, how did you do that? That's amazing. And it just means showing up every day and doing the consistent habits to get us there. And that's true in lots of areas of our life that matter. I think about my marriage, I think about my parenting. It's all these small, consistent things that matter. Same thing with my faith. It's like just showing up every day and understanding what my relationship to the Lord looks like at a deeper level, like that. Again, just builds this this foundation that is almost impossible to shake on all those arenas. And I think an easy one to see too is like fitness, right? Health, nutrition, those things. If I make one meal does not affect my my health really good or bad, right? Like I can go eat a donut or I can go eat a chicken breast, right? And that one decision is not going to make an enormous impact in my life. It's all of the tiny little decisions that start stacking up, right? If I have a donut every day, if I don't move my body at all, if I'm, consuming all sorts of garbage, cigarettes, it's all going to compound in a way that's negative or positive, right? If I'm making those right decisions. And the same thing is true in our wealth building. It allows us to just compound over a long period of time. So good. Any other questions there? Because I've got one other thing I want to highlight in this, a few other things in this.
No, please go ahead.
Yep. So I think another thing that we've also seen with clients is when you enter into this legacy phase is people get really we've seen this in a couple different industries. First one is real estate. The others, we'll call it farm ground, where they don't care about ROI at all. They care about building the asset, the cash flowing asset base. And so this is not an approach you can take when you're in, I'll say, really any of the other phases of life, okay, of your business. You can't do it in the build phase. You can't do it in the protect phase, and you can't do it in the multiply phase. It only happens in the legacy side. And what you do is, and I'm going to use a real estate example. My uncle is a very successful real estate investor. He's got a friend that owns property in this neighborhood, and anything that comes for sale. So he's got about $1 million a month net cash flow, and this was the number 10 years ago. So it's probably $2 or $3 million a month now. But he's got $1 million a month net cash flow. And anytime a property came for sale, he just bought it. He did not care what the price was. It was in his neighborhood. He bought it because he wanted to just add to that cash flow machine. And so you can't do that when the ROI matters, when you're taking on debt. This guy didn't have any debt. He just had the cash stacking up, and he was like, yep, that asset's for sale. I'm going to buy it, and it's going to just continue to add to the cash flow. So we've also seen it, and then that machine he's just creating a cash flow machine, and it just keeps compounding, and he's building just tremendous wealth all the way around. Those assets have appreciated. He's stacking up cash outside of the business, still generating more cash. So it's impressive. And we've seen the same thing with, we'll call it generational farm. I live here in Iowa. We're kind of pressed up against the river here. And so when it's some of the best farm ground in the nation, and when it comes for sale and it's close by, farmers don't really care. They will just buy it. And if they've got enough assets and cash flow, they know that this ground's been in the family for 100 years. It's going to stay for another 100 years, and they're just going to keep building this legacy, generational, multi-generational asset. And if you or I looked at that investment, we would go, man, that pencils out to like a 2% return. Why would anybody do that? And they don't care. They are not measuring it on ROI today. They're measuring it on long-term legacy. And I think that's a key piece of how the mindset starts to shift in this this piece. And again, looking at risk, we've seen both ends of the spectrum on this legacy side. We've seen now is the time you can go take some moonshot type bets. Might be that software company your buddy's starting, or the other way, it's like, I don't really care if my ROI is 0 or 2 or 1%. I'm just acquiring this thing because it fits into my overall vision for where I want my legacy to go.
Yeah, that's really good stuff. And through just zooming out and looking at all 4 stages here, build, protect, multiply and legacy. The common thread here isn't avoiding risk. You're an entrepreneur. There's always going to be risk, and it's just a matter of how magnified that risk is going to be. It's more so of understanding how to take it. So I think just one of the final questions I have is how someone should be thinking about their role as the entrepreneur, the person making those decisions.
Yeah, this is good. Um, and one thing I think I want to let's highlight back at the legacy for a second that I think is worth talking about. And then we can come back to this. But one thing that I think is super important that when we think multi-generational, when we think legacy, we oftentimes think about money, right? And but I think one thing we need to be mindful of is if I have two assets, one of two assets I can pass on to the next generation, and the first one is a big pile of money, and the second one is wisdom, I want to pass on the wisdom, because if I pass on the money without the wisdom, they soon won't have any money, right? They'll have neither one. But if I pass on the wisdom, they'll figure out how to get the money. And so I think what happens here in this legacy phase is there's a real opportunity to bring people along in the process. And going back to that investment policy statement, where do I want to allocate my capital? And I think there can be a ton of value in bringing people along in this entrepreneurial journey that sort of have the skill set and the desire to want to be an entrepreneur. It's not for everybody, but the people that do, having them, you can come alongside them, sort of have a seat at the table, and you can help pass on the wisdom from all the mistakes you've made, right? You can bring some capacity to the table from a financial point of view that makes the process a little easier for that next generation. Not that you want to make it super easy. There's so much value in the struggle and the trials, but to just create some, I've had a client say positive operating leverage for that next generation to be able to go farther faster because they don't have the strain of either huge debt burdens or just lack of capital to make things work. So I think that's awfully important. And then I think a piece on the legacy side that is worth considering is we'll call it just charitable impact. How can I impact people or causes that I'm super excited about? And there's no financial return on that. And I think that's actually a beautiful thing. It's okay to take these dollars and invest in people and causes and things that matter. And, we think about things like Project Rescue, which is taking people out of effectively sex slavery over in Europe. It's a terrible, terrible thing. And I think about, yes, any dollar allocated to that is a fantastic use of resources. That's stewarding the financial resources well. Sure, I could go earn another dollar in an investment, but think of the impact it's making on somebody's life doing something along those lines. So I think when we get to the legacy phase, it's not just financial legacy. It's how do I leave a legacy of building wealth from a multi-generational perspective? And I think we need to be mindful of what wealth is. It's not another zero. It's this most valuable things in life, this acronym REACH, relationships, experiences, advancement. We're talking about that right now with advancing wisdom and knowledge onto the next generation. Contribution, it's better to give than receive. And then our health, our spiritual, emotional, and physical health. Those are the most valuable things in life. And if we can, I'm also down for somebody that wants to, put $100 million in the bank and grow it to $1 billion. Totally fine, because money supports that acronym REACH really well. And if that can extend to more people that can live a full life, and I think that's amazing. If we're doing it for another zero's sake, we found that to be pretty empty. Our most successful clients are actually, they've figured out that cool, money's a lot of fun, but I'd rather go make an impact after I get to above a certain level. And so I think all of those pieces, when we think about that legacy side, is awfully important to consider as well. And so, Michael, I know I took us off that your question
No,
to go
that's
back to legacy there for a question, but for a minute. But I think that was a important piece to cover before we moved on. So
no,
let's
that's
reboot that if that's okay.
no, that's so good. And I was thinking about the book Die with Zero, which I haven't read, but you brought up to me several times, and I need to read it. And that at the end of the day, money, like you mentioned, it's a tool, and we believe it should be used to help support that REACH acronym to help us live our best and uh, fulfill our lives. And I mean, if we don't live to that REACH acronym and we die with $100 million in the bank, I mean, you can't take it with you. So, um, just a thought to add there that, to build on that. But yeah, just going back to zooming out on the 4 stages here: build, protect, multiply, and legacy, and kind of thinking through how risk is always going to be involved. You're an entrepreneur, that comes with the job description. So it's more so of understanding how to take it. So I was more so wondering on how someone should be thinking about their role as the person making those decisions.
Yeah, yeah, and I think the interesting thing about being an entrepreneur is it is a very, very dangerous place to be to stop taking risks. And I think there's a common example of Blockbuster Video versus Netflix, right?
Mhm.
Blockbuster was like, we're just going to play it safe. We're going to just keep renting VHS tapes to DVDs, and it'll all be fine. And it didn't work out. And so I think as an entrepreneur, like you need to be constantly testing the boundaries in the marketplace to see where the new opportunities are. But you do that with the mindset of I'm going to build an infrastructure around me to make sure that I'm protected. And ultimately, um, we want to make manageable risks. We want to take reasonable bets. Now, I know fortune favors the bold. I think we just need to be bold in the right situations and make sure that if um, we're making those bets, we're not going to do something that can derail the whole operation. So managing risk is an important part of the whole process. But I think through the entire thing, we're never stopping the 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 we're never getting out of a situation where we're not taking some risks. I think it's almost essential for us to continue to grow and develop.
Yeah, awesome. So if someone's listened to this and this conversation's landing with them, um, and they want to do some sort of assessment on themselves,
Yeah.
do you want to walk the listeners through our risk assessment?
Yeah, yeah. I think this is good. So if you're listening to the car, come back and listen to this when you get back to push pause and just wait till you get to a spot. But just got 5 questions, and I think it's worthwhile to um, 1 to 5. You can rate these. The first one's actually not a 1 to 5, but um, so the first question is: I understand what stage I'm in right now. Are you in the build phase? Are you in the protect phase? Are you multiplying, or are you legacy? Like, where are you at? I think it's good to know. And then the second question, 1 to 5, my risk taking aligns with that stage. So, 1, it doesn't align at all. 5, it absolutely aligns. Um, and then number 3, I have financial structure to support my risk. Because this again goes back to our previous conversations about built to last. Like I need to have this infrastructure around me, and the financial structure is critical to support the risk profile. It allows you to take the risks. So 1 to 5, I have the financial structure to support my risk. Then the fourth question, I avoid distractions that pull me from my core opportunity. So 1 to 5. And that's a hard one for us entrepreneurs. It's so easy to get distracted by new opportunities. that not only take our time, but our focus away from the thing that's driving our wealth and the opportunity we have in front of us. Number 5, my capital allocation reflects long-term thinking. Again, this goes back to our conversation, Michael, about those slow, consistent growth profiles stacked up time and time again. Just makes a tremendous impact. So just making sure that our capital is allocated to reflect that long-term thinking. So 1 to 5, how are you doing there? So I would say if you hesitated on more than a couple of those, your risk might be misaligned with your stage, and that's something to keep in mind. These are things we love helping our clients with. We love these conversations. We love seeing people grow and the impact that they can have. So if any of this resonated with you, we'd love to continue this conversation. You can go to vitalwealth.com. You can schedule some time with us to talk more about it. You can also sign up for our newsletter, vitalwealth.com/resources. We're going to be putting out, you'll get these episodes every week. We've also got a newsletter that's going to come out. It's just going to continue this thinking and sharing these thoughts on how not to just build wealth and pay less tax, but ultimately live an optimized life. So we just find that financial clarity just gives you the ability to take the right risks. And without it, even good decisions become somewhat dangerous. So this has been a lot of fun, Michael. I do appreciate this conversation and our time together today. Anything else to add before we wrap up?
No, this has been awesome. And I believe we have our mini series finale coming up. That'll be a good one. I won't spoil any of that, but I'm excited to get to that. This conversation today has been great. And it's been a pleasure, Pat.
Yeah. Thanks so much for joining me here today and working through these things. It's a lot of fun.
Love it.
That's a wrap on today's episode. Thank you so much for tuning in. I hope this conversation gave you a clear framework for how to think about risk, not as something to avoid, but as something to align with where you are and where you're going. Because the goal isn't to take less risk, it's to take the right risk at the right time. If this episode resonated with you, share it with someone who could benefit from this perspective. And if you haven't already, take a minute to leave us a review. It really helps us reach more entrepreneurs like you who are building something meaningful. And if you want to go deeper, don't forget to check out vitalwealth.com/resources. We've built out a full library of tools and strategies to help you minimize taxes, build wealth, and make better financial decisions. Again, that's vitalwealth.com/resources. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. You're vital to me because you're committed to growing your wealth, leading with purpose, and creating something that lasts. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives. That's